Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. One last look at that disclaimer. And let's welcome Dimitri Pargamonic to the stage. How you doing, Dima?
Good morning, Will. How are you?
Great. So today we're going to talk about IV Percentile Rank for a specific option contract.
Yep. I'm gonna share my screen here. And one sec, everyone. And yeah, I'm gonna go to show an example of an IV percentile rank for an option contract. And I think it's a follow-up on a previous question we get, and sometimes people say, well, what's the IV rank for, let's say, Apple or Google, right? What's the implied volatility of Apple or Google? So I think that this exercise will kind of help clarify, where do we get the implied volatility? What does implied volatility mean? And take a look at it at a granular level. So I'm going to try to use an example here. Let's go. We're on the main page here. I'm going to go to a symbol, let's say Google. And when we'll end up at this main page, and then I'm going to go to the options and click on option chain. Okay. And let's click on this menu to minimize it and expand our screen. So when we talk about implied volatility, well, where does the implied volatility come from? Because the Google stock doesn't have an implied volatility itself. The implied volatility actually comes from option prices, right? So you have an option price, you put it into an option pricing model, you put in the different factors of the option in, like days to expiration and the strike price, where the stock price is, the dividends, the interest rates. You put all that into that model, and it gives you an implied volatility. So you need all that to come up with an implied volatility. If we look at the stock alone, like say Google, well, we can't get an implied volatility from it, right? We would need, because the option pricing model requires you to put all those other pieces into it to get an implied vol. Well, if we're putting in all these factors into the option pricing model, it needs inputs. You need a strike price. Is it a call or a put? Is it what is the price of the option? What is days to expiration? So we need all that, right? And when we put that in, if we change one of those inputs, the implied volatility will change. If we change the days to expiration, we'll get a different implied volatility. If we change the price of the option, you'll get a different implied volatility. If you change the strike price, you're going to get a different implied volatility because you're changing the inputs. Okay. So knowing that, well, that would mean that every option on the board here has its own unique implied volatility. All right. So let's come out here. Let's say to these are the different expirations available for trading in Google. So I clicked on August 22nd, and now we have all these different call options. So these are the strikes, all these different call options. We have all these different put options. And as you could see here, we have these implied volatilities. We have an implied volatility for the bid. So let's say here is a 205 strike. The calls are on the left-hand side. Well, we have an implied volatility for the bid, 25.5, and we have an implied volatility for the ask, 26. Why do we have two different implied volatilities for the same option? Well, that's because you have two prices here. You have a bid price and an ask price. And because those prices are different, you're going to get a different implied vol, right? So if you have if you use a price of $2.54, with this strike, these days to expiration, the interest rate, all this, you put it in the model, you get 25.5. But if we change the price to $2.63, well, now we have a different price. So we're going to get a different implied vol. So you can see here that, so there's no such thing as what is the implied vol of Google. It's really what is the implied volatility of based on these option prices. Okay, so what these option prices is saying that's the implied volatility of Google from here, to expiration based on these inputs. Okay. So now that we have all these, implied volatilities, then the question is, well, if all these options have different characteristics, so over here we have options with different strikes, right? So this option, let's say with a strike of 220, is not the same thing as an option, which is 11.5% above the current stock price of 197. Well, that's not the same thing as an option that's strike price of 200, which is only 1.3% of it. In addition to that, well, we have options that have longer expirations, let's say September 5th. Well, this has 26 days to go. If I go back to August 22nd, this has 17 days to go. So you could see here that these options have different characteristics. They're not the same. You can't say, well, what's the difference if I buy a 200 strike call versus a 220 strike call? Well, the difference is you need the stock to go up by more, right? For 220 strike than for 200 strikes. It's a different option. What's the difference if I have August 22nd or September 19th? Well, you have one option that has more days and more time to become profitable, right? So these are important differences, and then we have to evaluate them based on those parameters, based on those factors. So just to give you an analogy, let's say I have a list over here of real estate properties. If I have a list of real estate properties, I could have 2 bedrooms, 1 bedrooms, 3 bedrooms. Some of the 2-bedroom condos could be 10 years old. Some of them could be 1 year old, right? Some of them could be in a building with amenities, like such as a pool and a gym. Some of them could be in a building that doesn't have any amenities. So now I have all these different prices, right? And those different prices reflect the unique parameters or inputs or factors of all these different real estate properties, right? So I have a bunch of 2 bedrooms, I have a bunch of 1 bedrooms, and I have these different prices. But what I'm trying to do is compare the price of this property relative. So I need a benchmark, right? What is the market price relative to some benchmark, but to something similar? So if I'm looking at a 1-bedroom condo, potentially as an investment, well, if this 1-bedroom condo has views, it has a balcony, it's in a doorman building, and it has amenities such as a gym and a pool, well, I need to compare that to similar inputs, right? I need to compare that price to historically, where did people purchase and sell a similar 1-bedroom? Because it doesn't make sense to compare that to a 1-bedroom that doesn't have the amenities. Maybe it doesn't have the balconies. Maybe it has obstructed views. Well, there's a different price to it, so I need to compare it to those parameters. So that's the first thing we need to do, and then we want to see, okay, what's the market price, right, relative to its historical prices where something similar happened. Okay, so that's where these IV percentile ranks are doing. So let's do this. Let's click on this 220 call, and this is saying IV percent 64%. So what does that mean? Let's click on this. It's going to pop up the IV percent. And here is what it's doing. It's saying, okay, what we're looking at is a call with 17 days to expiration, and the spot price is 11.5% away. The strike price is 11.5% away from spot. Right? So it's trying to compare this to similar situation. In other words, we don't want call options that are 10% in the money or at the money, and we don't want call options with 100 days to go or 1 day to go. What we want is to see call options with 17 days of trading and that they're 11.5% away. So this way we match it up. And then once we match it up, we say, okay, now we went back in history, found those situations. And now let me see where the implied volatilities were for similar options. Okay, now if you don't have a similar, we could create synthetics, but I think this is going back and looking at those similar options. Okay, so these are all the dotted lines here. These are our historical observations. So now we could see, the implied volatilities, how high they got, how low they got, where do they cluster around, how much do they move around. So this dotted line here, okay, this dotted line, that's where we are right now. So the dotted line kind of just shows us from a historical perspective, where did the other observations fall? How far below, how far apart, how far above, did they cluster around the current level? So we're taking the midpoint, we're taking the midpoint and looking at historical midpoints. So now we could see, what does this mean? So right now, this is the current level. So we're taking the midpoint of 26.8 and 27, so 26.9, right? And we're saying, okay, now that we have the current level, what percentage of these green observations, right? These are the historical observations, fall below, right? So that's 64%. Okay, so if 64% of the observations fall below, then the rest, 36%, are above. So what does that tell us? Is that right now, where are we relative to historical levels? So if we're at the very high, right? If we're like above this point over here, well, then the IV percentile rank will be 100%, saying 100% of all our observations are below. So we're on the highest end of the historical range. If this fell below zero, I don't know, below this one, maybe somewhere here, if it's zero, that means 0% of our observations, we didn't find any that are below the current level. All of them were above. Okay, so that's the IV percentile rank for this option contract if we get, based on historically, if we looked for similar attributes, right? Similar parameters, 17 days to go, 11.5%. And then we have these other stats here. The average of all of them is 25.2. Okay, so that's the average of all these. So, even the large outliers and all these are 25.2. The median is 24.6. Minimum is 16.9, and max 56.3. Okay, so that's where that's the a way to look at the historical taking the current implied volatility, right, comparing it to historical to get a quick sense of where are we now, relative to, a benchmark, relative to the historical benchmark. Okay. And this here also just gives us an IV percentile rank for each of these options. So I'm going to stop right there. I think, and throw it back to you.
That was great, D. Great how-to. Everyone is much appreciative of all the work you do for the Chameleon community. Thanks for doing it, buddy.
All right. Thanks, everyone, for joining. Stay safe out there, and we hope to see you tomorrow.
See you tomorrow, D. Bye. Thanks. Hey, everyone. Thanks for joining our webinar series again. Please thumbs up. Follow us on all the social channels. Wow, something strange with my head right there. Thumbs up, particularly on YouTube. If you're following us on YouTube right now, everyone have a great trading day, and we hope to see you tomorrow.